Barron's Roundtable, sponsored by Global X ETFs.
Welcome to Barron's Roundtable, where we get behind the headlines to prepare you for the week ahead. I'm Jack Otter. Coming up, higher rates could be here to stay. Apollo chief economist Torsten Slok will react to the blowout March jobs report, plus why he's been saying rate cuts are not coming at all this year. Then, the retail nightmare that Jack Howe has labeled Underpants Armageddon. You heard it here first. Then, the surprising new snack coming to McDonald's. But we begin with our expert panel and 3 things investors ought to be thinking about right now. On the Barron's Roundtable, my colleagues Ben Levison, Teresa Rivas, and Jack Howe. So, Ben, the market was down this week, but you say it was misunderstood. It was down for a different reason than most people think.
Yeah, I mean, if you just looked at how the market did, and S&P 500 was down about 1%. It was its worst week since January 5th. And then you looked at the jobs data that we got on Friday, 303,000 jobs created, a lot more than expected. You would have thought, uh-oh. People looked at the market, looked at the data and said the Fed's not going to be cutting rates and the stock market would drop. But that's not what happened. We actually had a great day on Friday. S&P up more than 1% when they got that jobs number. I think people, looked at that and were kind of excited. But it was down more because of oil going up. And that signals maybe that geopolitical concerns are weighing on stocks. The other option is that stocks have just gone up a lot and people are looking for any excuse possible to knock them down.
But on Friday, as you said, up. And I guess we're maybe back in a good news is good news situation where that strong hiring number says, okay, good economy, I'll buy stocks?
Yeah, I think that's right. When you look at what's happening, everybody wanted these rate cuts, but if the economy is strong, and that's what the jobs number shows, then there's a good chance that the strong economy will translate into strong sales, which translate into strong earnings. And really, all that investors care about in the end are those earnings. If the earnings go up, we're going to do okay.
Next week, we'll get another inflation print, and I think June is probably off the table now in terms of a rate cut, most people think, unless something changes. So July, you think that's when there could be one?
Yeah, I think, it keeps getting adjusted out. Remember, at the beginning of the year, we were supposed to have 7 rate cuts this year. At least that's what the market was pricing. The Fed wasn't going in that direction. And that's kept coming down, and now it's getting pushed out. And I think that's exactly what's happening, is that the market is looking at the data. It's data dependent. The Fed's data dependent. They're making the changes. But for right now, it can handle it. That CPI number, if it is too hot, that's where it's going to be a problem. People can still make the argument that inflation is, coming down, even if it's coming down slower than it was. But if we get another blowout number, that could be an issue.
All right, and we'll hear from Torsten Slok soon on what he thinks the Fed will do. Teresa, we had an earthquake in New York on Friday, unusual. A much worse one, of course, in Taiwan. Humanitarian concerns first, but there's also an economic impact here.
Certainly. So obviously, we're still counting the humanitarian toll of the earthquake, but the economic fallout is something that's being considered from Beijing to Washington, D.C. Taiwan was already a flashpoint between the U.S. and China, and now you add in the fact that it's a supplier for a huge number of big tech companies, and they need semiconductors from Taiwan Semi and all the other corporations there. So it's something that everyone's watching very closely.
And Taiwan's not the only hotspot, South Korea as well.
Exactly. We also have concerns from South Korea because their proximity to North Korea rattles investors' nerves, and they have a long-standing conflict there. And it just shows how vulnerable global supply chains still are.
There is a solve to that, but it's not a quick fix, right?
Exactly. So the Biden administration is trying to incentivize more companies to make chips in the U.S., in places like Arizona, in Ohio, but that's just going to take time. There's been delays, so it's not a quick fix.
Alrighty. Meanwhile, Jack, bad news from a couple of drug makers this past week.
Well, you can contrast Biogen, which has been an awful performer, near 52-week lows. They had some bad news. The FDA wants more information on their experimental Alzheimer's drug, so that's going to be delayed. And then Merck, that one's hitting fresh highs. There's been approval there in Europe for its Keytruda cancer drug and a combination therapy, and also in the U.S. for its hypertension treatment. And so investors usually look at these and they say, what's the likelihood of new revenues? How does that compare with the coming patent expirations? And they make a decision. We've got a cover story in Barron's this week that says investors in general might just be too bullish on the entire big pharma group. Companies like Pfizer, Bristol Myers Squibb, Johnson & Johnson, and Merck, even Merck, been poor long-term performers, and there are tens of billions of patent expirations coming by the end of the decade. A company like Pfizer, as an example, would have to add another company the size of Eli Lilly to make up for some of those expirations. It's not going to happen. If you suffer from excessive bullishness on big pharma, I think this cover story will probably cure you of it.
Pfizer was selling at the same price it was on Friday back in 1998. Real quick, one bright spot is the obesity drugs, but you're probably going to tell me that they're not here forever.
Yeah, they've already run up, right? And we're about 10 years away, plus or minus for Lilly and Novo Nordisk from them facing the same patent expiration. So we might go through the whole cycle again.
All righty, stay away from those drug stocks. Surprisingly strong hiring is dimming investors' hope for rate cuts this year. My next guest says he doesn't expect a single cut in 2024. Apollo chief economist Torsten Slok explains next. March saw a blowout jobs report, topping expectations by more than 100,000 jobs. The economy added 303,000 jobs last month, and the unemployment rate ticked down to 3.8%. What does the latest data mean for the Fed's next move? My guest has been saying he does not think the Federal Reserve will cut interest rates at all this year. Joining me now is Apollo chief economist Torsten Slok. Torsten, great to see you again, as always.
Thanks for having me.
So you have been on this, you've been driving the higher for longer bus for a while. I think that Friday's data point moved the market a little bit closer to your point of view, but you're still kind of an outlier because you're not saying fewer cuts, you're saying no cuts at all this year. What's going on in the economy that convinces you of that?
Well, I think what's very important is that we are seeing a very significant wealth effect. We're seeing the stock market is up about 10 trillion since November the 1st. We're seeing credit spreads have tightened. We're seeing interest rates are lower since where they were in October. On top of that, we've seen crypto prices also go up. These things are providing a very significant tailwind to the economy. For example, the 10 trillion increase in the stock market, compare that with last year, consumer spending in total in the US was 19 trillion. So we have a very significant tailwind to the economy and consumer spending over the next several quarters because of easy financial conditions, because of the stock market going up.
And interesting point that I saw in one of your notes, which is that when crypto goes up, people feel more willing to spend that money. Did they think of it as house money, or what's going on there?
Yeah, I think that's very important. So papers are showing that the marginal propensity to consume, meaning your tendency to spend out of gains in crypto, are basically double out of your tendency to spend out of gains in the stock market. So therefore, when crypto prices go up, and that's very broadly distributed across the income distribution, you tend to see also more consumption spending as a result. So remember, the crypto market is roughly a little bit less than 3 trillion, and therefore it has been a fairly significant wealth gains for a lot of households.
I want to ask you about, do you remember when we used to talk about the Fed hiking rates, and we say, well, there's always a lag, right? So we don't see it now, we're going to see it later. Now it's more than 2 years, we still haven't seen it. What's going on?
Yeah, that's right. People at the Fed and the textbook would tell you that normally it takes 12 to 18 months before interest rate hikes begin to slow the economy down. That is also still the case mainly through the unemployment rate. The unemployment rate has gone up a little bit, and that has had some impact, certainly on those consumers who have more debt. But the other part of the transmission of monetary policy and what the Fed is doing to the economy is exactly what's happening to the stock market. So when the stock market, remember, the total market cap of the S&P 500 is about 43 trillion. So when that goes up 25% in a matter of 5 months, that is a very significant boost to the amount of money people spend at restaurants, on airlines, hotels, concerts, sporting events. So therefore, we should expect to see, and this is exactly what we're seeing in the data, more support to consumer spending more broadly over the coming quarters. And that will come more quickly than the traditional channel of pushing the unemployment rate higher.
Okay, speaking of unemployment, you send around wonderful charts almost every day. Friday morning's chart showed the effect of immigration on the unemployment market. Can you explain that dynamic? I think we have the chart.
That's been a very important development more recently, where a lot of the jobs that have been created in the economy have been partly because of an increase in immigration. And what the chart is showing is that the significant increase in jobs we've seen in the last 3 months has been coming from foreign-born workers that have found jobs. So as a result of that, immigration is helping. The Congressional Budget Office has been estimating this. That's also from the Hamilton Project under the Brookings Institute. They have all been estimating that immigration is playing a role whereby we will simply have more job growth simply because immigration has gone up so much. So one way of looking at the employment report that we got on Friday is that this was also driven by the fact that immigration is having a tailwind at the moment.
Let's talk about the markets real quick. Where does one want to invest in a higher for longer, stronger than expected economy?
Yeah, so let's split that into fixed income, meaning bonds,
Great.
and to equities. So first, of course, if interest rates are staying higher for longer, that means that you should be, popularly speaking, cutting coupons. You should be benefiting from the level of interest rates being higher. You could do that in public markets. You could do that in public credit. You could do that in private credit. The spread is very high by historical standards. In particular, in private credit, you see yields that are at very high levels relative to where we've been historically. So the first answer to your question is, what should you do as an investor? You should be, in particular, in front-end fixed income in the first 3-5 years in the yield curve and cutting coupons and benefiting from the level of yields being higher. In particular, if eventually the Fed will be cutting rates, this is a good time to put money into the front end of the yield curve, meaning fixed income that is giving a nice yield. On equities, of course, there is now a very significant development because rates higher for longer means you should also see the economy better for longer and therefore earnings better for longer. That would argue for its stock market going up. But at the same time, now you also have interest rates higher for longer means that companies have to pay more in debt servicing costs. That would argue for the stock market going down. So there is a tug of war between the forces that are driving equities at the macro level at the moment.
The good news is that we've seen a broadening in the stock market. So it's not just the Mag 7, which actually are not doing so well, but I think 80% of stocks, 75% of stocks are above their 200 days. So that's a good move.
Yeah, absolutely. And the Magnificent 7, exactly as you're highlighting, have seen quite some widening in terms of performance. It used to be 6 months ago that Magnificent 7 were moving up and down together. But we've begun to see Tesla, Apple, Alphabet start to underperform relative to, in particular, Nvidia, of course. So that widening in the gap is basically making me doubt a little bit. The AI story is beginning to fall a little bit apart. The Magnificent 7 story is falling apart because it's becoming more complicated, which means that we as investors now need to do more homework to be the right stock pickers and credit selectors, pick the right assets, which, of course, are therefore the ones that will be outperforming relative to those that currently are underperforming.
That's why we have you in the show. Thanks very much, Torsten. We appreciate it.
Thanks for having me.
Some fashion stocks are going out of style. Is Lululemon on the wrong side of the newest trend? And can a big celebrity name save Calvin Klein? And why is China pulling ahead? That's all next. The apparel business is struggling in the U.S., consumers trying to save by pulling back on purchases or switching to cheap foreign alternatives. Jack, give us the skinny on the trend that you have dubbed Underpants Armageddon.
Well, you know, Calvin, the stock PVH, that's the maker of Calvin Klein, that was down 22% on Tuesday. And then I looked and saw Hanes Brands was down 11%. So I thought, it's a problem in underpants. I thought maybe artificial intelligence made underpants obsolete. I'm not a technologist, Ben. But it turns out I was way off. It's Europe that's the problem. And it's not just underpants, it's apparel more broadly. Companies like VF Corp, Tapestry, Ralph Lauren, they all sold off mid-single digits. PVH got hit hardest because it has the most European exposure of the group. And it's also eliminating some low-margin channels there, and that's really going to bring its sales lower this year. It's also a turnaround in progress. So that stock had been up more than 50% in the few months prior. So this is sort of giving back some of those easy gains.
And underpants are a little smaller in Europe, right? I don't know if that has.
I'll check my sources.
Okay. Yeah. Let's switch to one of the few bright spots in this industry, a 170-year-old company, Levi Strauss.
Levi sold off with the apparel group on Tuesday, but then it bounced back even more on Thursday. Great results, taking market share, moved up guidance. It called out loose fits for men and ladies. It said they were both up 40% recently.
All right.
And if Levi is right, then Lululemon has a problem. I mean, Lululemon makes those $100 yoga pants very tight. And they just had earnings this past week, came out, and the earnings were fine, but the guidance, not so good. And I think the concern has to be, and this is coming from Randall Koenig over at Jefferies, is that you're going to have people looking elsewhere than those tight yoga pants that have been so stylish for so long. And I know people like me have been waiting to see them go away forever. And he compares it to Under Armour, which is another company that at one point was very popular. All the kids were wearing it, and then it seemed like overnight Under Armour just stopped being the thing that you had to have, and their stock has been terrible ever since. And so we'll just have to keep an eye on there and see if really this is it for skinny pants.
Well, this isn't really anything new because skinny jeans were one of the first styles that went by the wayside during the big fashion shift during the pandemic. So I'm not surprised to hear that wide leg is in, because for women, that's been the case for several years now.
But Teresa, explain to me, you know, you got these baggy pants that are in. Why are the tops so tight?
Because we have to show you that we're still hot.
Simple math.
Let's go more broad, Teresa, to the rest of the retail industry. That's your beat. What are you seeing?
Well, we've seen since the pandemic, the biggest retail players have been getting bigger. But other companies, it's been sort of touch and go, depending on what part of the market you're in. Now, consumers have been surprisingly resilient the entire time. But it's undeniable that Americans are under pressure. We have seen consumer confidence dip recently. There was an uptick in unemployment, and polls show that people of all political persuasions are really stressed out about the November election. All those things make people less likely to shop, and we've seen a lot of retailer stocks suffer because of that.
There's another interesting dynamic. I remember when H&M came in with fast fashion and upset the retail industry. Now H&M is looking over its shoulder at even faster fashion.
Exactly. So we've all heard of fast food. Fast fashion is something like that. It's trendy, cheap, and really quick turnaround. So much more speed over quality, let's say. And exactly, you used to be able to get a trendy top at H&M for $15. Now you can get one for $5 from Shein or Temu. Again, it's simple math. So, and people are also buying as they're scrolling social media. That's a huge problem for a lot of retailers that now have to compete with these new entrants that have extremely low prices.
I'm guessing the $5 shirt doesn't last too long, but I don't know.
Definitely not.
Jack, before we go, I got to ask you, can Jeremy Allen White save Calvin Klein?
Maybe. He's the star of a Hulu drama about chefs called The Bear, and management called him out 4 times in their latest earnings call. He's the new face, and he's really the new torso on the billboards for Calvin Klein. And they say it's the biggest cut-through campaign in all of the fashion industry, so that sounds good. I mean, I think it's a little bit of an unrealistic, appearance standard. This is supposed to be about body positivity, so if we're going to do chefs selling underpants, I say give me like maybe Emeril Lagasse. Where's Guy Fieri? Welcome to Flavortown, right? Some mid-rise trunks. I'm thinking out loud. So
I'm thinking, what's wrong with the old Victoria's Secret catalog?
That's a topic for another day.
Alrighty. In that case, Teresa and Ben have a pair of investment ideas, and Jack says a surprising new item is going to appear on McDonald's menus. Stay right there. Jack, it may be a good thing that skinny jeans are on the way out, because Krispy Kreme has a new distribution channel, and there's about 13,000 of those distribution channels. It's
a big one. Sometimes high finance is complicated, Jack, but this is not one of those moments. Krispy Kreme, we're familiar with the products, the chocolate-covered ones, the glazed ones. Delicious. Too little distribution, and the stock has been a poor performer. It had recently been trading below its IPO price. McDonald's has been testing Krispy Kremes in Kentucky, and it turns out that people really like to buy donuts through the drive-thru. You drive up, you get your donuts, you eat them. It's simple math. So they've done well. Now they're going to roll them out nationwide, right? And Piper Sandler calls that a game changer. The distribution, the number of doors, as they say, could more than double here in the years ahead. So it's going to be pretty easy to increase sales. Piper Sandler upgraded the stock to overweight. Don't you dare make a fat joke about that, Jack. It says that shares could hit $20 from here. They were recently $15 and change, so some pretty good upside there.
I've seen Krispy Kreme donuts for sale in a gas station, like between the vaping thing and the candy.
Still take them, by the way.
McDonald's sounds like a lot better. All right, let's go to actionable ideas. Ben, what do you have for us?
I'm looking at Albemarle. There it's a lithium miner. Now, this was not it's used in EVs, and this has not been a good time for EVs. We saw Tesla this week came out with a terrible deliveries report. It's dropping down to a support level. bit frightening. But if you look at what's happening with metals right now, their prices are going up. Copper's going up. Gold and silver are going up. And I think that at some point you're going to have to see lithium prices go up despite this overproduction that has happened there. And with the stock, Albemarle, down so much, it's about 66% from its high in 2022. I think this is a good time to start nibbling on it. It's an interesting moment for it. And if that lithium price turns around, Albemarle should too.
Alrighty, next week we're going to have the CEO of Mercedes on the show. We'll hear from him how electric cars are selling around the world. Teresa, what's your actionable idea?
Well, they say a rising tide lifts all boats, and that's certainly true in the cruise industry. All of the major operators have seen unprecedented demand, record bookings, and big price increases. Unfortunately, Carnival stock has been left out of the party. Now, it's certainly not the best cruise operator out there, but it's made a lot of strides. It's really catching up. And after a recent sell-off, I think it's time for investors to get their feet wet.
Alrighty, and leisure and hospitality is where it's at, we learned in the most recent jobs report. Thanks, guys. To read more, check out this week's edition at barrons.com. Don't forget to follow us on X. That's at Barrons Online. And that's all for us. We'll see you next week on Barron's Roundtable.